All right, hello everybody. Welcome. My name is Hong Lu, and we will get started. Oh, there we go. That's the alarm to get started. All right. So, welcome. We are, what are we? April the 29th, and we will be looking at a calculation today on whether or not it makes sense to get into real estate at a crazy, insane loan amount for a very short term. Okay, so a lot of times in real estate, we look at acquiring a place and then potentially having a private lender come in at like 12%, 15%. And so today's calculation is going to be whether or not it makes sense to do a short term lender for about a year or two, and what those numbers may look like for a potential investor, and like at what point does it not make sense and what point does it make sense. Okay, so we're going to look at that. And then I do have a question here, so we'll put that until the end if we have time. So, okay, so this is Monday, April 29th, 2024. And this is our Monday session on Money Matters. So my name is Hong Lu. I am with Cash Property Inc. in Canada. And, the outcome of these calls is really to help fellow accredited investors make sound decisions. And so today's question or today's analysis is a really good one, because like with the economy the way it is, the borrowing interest rate has gone up significantly. So even on private lending, it's very hard to get a private lender to come in and fund your opportunities at 7 or 8%. Like a lot of these are 10, 12, even 15% by the time you add in all the fees and the legals and administration and everything. Okay, so the borrowing cost has gone up significantly. So we'll look at whether or not it makes sense to do that. Okay, so that is the intro. Now, before you decide to buy an opportunity or not invest in an opportunity based on what you see here today, please go do more research, talk to another fellow investor. Okay, this is like, especially with today's calculation, I started this yesterday because I'm like, oh, you know what, that is a good question, because I've always just had an assumption in my mind about whether or not the opportunity would make sense at a higher interest rate. So it's good to actually put it down on paper and actually do the calculation. So I've only just built out the spreadsheet since yesterday. And so it would be good to, if you find an error in my sheet, or if you have a different perspective on how to look at this question or this analysis, please reach out to me. QR code right here, okay? To reach out and have a conversation about that. Okay, so let me put those away. So the other comments and questions, we will leave that till later. Okay, so let's jump right into the spreadsheet here. So this is about buying. So there's two ways to answer this question. So the question originally came in as, Hong, does it make sense to buy a primary residence at 12% plus fees and then refinance out? Okay, so I would say, okay, you know what? If it's a short-term loan for maybe like 1 year, 2 years at the most, it may make sense for you to buy it in your primary. Now, a primary is completely different than an investment opportunity. Okay. And then it only makes sense to do this one if you can refinance out or sell it at a significantly higher amount so that your interest rate is lower. Okay, so we'll run into that. Now, the one thing to keep in mind is that if you are going to sell this property, you may be hit with a capital gains inclusion rate at this 66.67, which is the new one that's coming in June. So just make sure you talk to your accountant about that, because that may affect your number significantly. The other thing is that it may make sense on a primary residence to buy it if you can house hack, okay, or if you can force the appreciation. Okay, so let's go into the calculations and we'll do both scenarios to see if it makes sense to do this either for primary or for an investment opportunity. Okay, so let's run through this first with a primary residence, meaning that you're going to live there So you're going to buy it, you're going to move in, you're going to live there, potentially maybe rent out a room or two. If you have a duplex, okay, fantastic. Like a basement suite that you can Airbnb out. Okay, so let's walk through this. Let me make this a little bit bigger so you could see this. Okay, so for those of us who are getting a little bit older and we need to be able to see things um, a little bit bigger. Okay, so let's run the first scenario here as this is a primary residence. Okay, so this is in Canada. Okay, so let's just say you buy a property, it's $1 million. We need 5% to close. So any of the green cells is the stuff that you want to adjust. Okay, everything else is you don't really want to mess with it. Okay. There's a 5% renovation amount, as a reserve. Okay, because a lot of times when we move in, we do want to fix things up a little bit. Okay, 25% down payment. So let's leave this here as even if it's your primary residence, let's just leave the 25% down payment so that we can see what that works out to be. So we're going to get a loan here of 25 a 25% down payment. So we're going to get a loan of 750. I'm just going to color this cell because we could play around with this number here. Okay, and this renovation number. Okay, so that means we're going to go and get a mortgage of 750. Now we're running the scenario here saying, okay, what if we can't get a traditional mortgage for whatever reason, and so we want to get a private lender to come in. So the private lender is going to give us a 1-year term, so 12 months at 12%. Okay, so that includes all of the fees, all of the legals, everything. So that means every single month I have to pay $7,500 for this loan. Okay, and the math on this is just my loan amount times my interest rate divided by 12 to get monthly. Okay, and then for the year, it's just times by 12. Okay, so, and then I want to calculate how much it is for that duration. So if I increase this 12 months to 24, you're going to see that this not because it's for the 2-year period. So let's go back to 12 months. And if I increase, let's say this for 15%, then you're paying $9,400 for a month in interest payments. Okay, now that's assuming that you get the whole amount from a private lender for this purchase, not going to the bank and then getting like a second mortgage from the private lender. Okay, so in this case, the NOI is going to be different because it's your primary residence. So let's just say your primary residence is 0. Okay, so then at that case, what happens is in year 1, so this is the year here, your debt servicing is 112. Yeah, 112,000. So that means there's no cash flow because it's a rent. It's your primary residence. So there's no rental here, rental income. So there's no cash flow. You're completely negative on this. Okay. So that means, and then I'm assuming that there's a 3% appreciation here. So let's just run this with 0 going across here just for a little bit, just to see what the numbers look like. You are negative cash flowing the first year. And so you're in a negative 32% return, okay, on your investment. So it doesn't matter if it's IRR or your ROI, because it's only 1 year, you're at negative 32. Okay, so now what I'm saying here is that in year 2, you're going to refinance, get out of this private lender, and now you're going to be at a 6% interest rate for 25 years. Okay, so for whatever reason, you weren't able to get it for the first year, but in the second year, you got it. Okay, so in year 2, which is this column here, you're able to get a traditional bank mortgage at 6%, 25-year amortization. So we are now, instead of paying 112,000 in 1 year for debt servicing for your mortgage, you're paying about 57,000. Okay, so a significant drop. And that's because we went down from 15% to 6%. Okay, so that's why that's down. But because this is your primary residence, you are making no money at all. Okay, so your cash flow is completely negative. So now you do have mortgage pay down here, which is great. So in a private lending situation, you do not have mortgage pay down. But in this scenario, once you switch to the bank, you're going to have a $14,000 mortgage pay down in your first year. Second year, you're going to have a 15,000 and then your 16,000, because every single year your mortgage pay down increases because you're tackling more of the principal pay down. Okay, so let me turn this NOI to 0 here and this one to 0. Okay, so now we're saying that the appreciation is still 0 in year 2. So now you are still making a negative return on your investment. Okay, so in this case, because it's your primary, you have to weigh out, okay, we're going to be living there. We're going to have an emotional tie. It's for our benefits, for our family. So maybe this negative return of 22% per year, okay, is okay, right? And then as the years go on, your IRR, your return on your investment, your loss is less because you're actually getting more mortgage pay down. And in this case, we have a little bit of appreciation added in. So let's take that out. And so we have no appreciation. Okay. So you can still see that just from that mortgage pay down, you still have a little bit of a financial gain here. Like it's not as big of a loss, okay, as you can see from this like 32 minus 22 minus 19, okay, because you're having that mortgage pay down. Okay, now if you can add appreciation, and so let's just say the appreciation is 5% every single year going across, okay, by the time you get to year 7, okay, no, we still need to go a little bit more. So we're at 5% appreciation here. Okay, so by the time you get to year 10, that's when you start getting out of a negative return on your money here, which is fine, right? So if you're going to be using it as your primary and you can get a mortgage for 6%, it starts making sense to actually, potentially do this, because if you're going to be in there long term. Now, when we were in a period where the interest rates were really low, like let's say 3%, okay, you could see that return in 5 years. So it actually made sense during very low interest rate times to pay 1 or 2 years of high interest to just get into the market, just to like get your first place or potentially get a second place, like a cottage or something. Okay, so in that case, it may make sense to do that. And if you could potentially even, let's say, house hack and even make, let's just say $5,000 in the year for your net operating income. So this would be all of your cash coming in minus your expenses, but not your debt servicing, okay? So here we're saying that you're going to have an NOI of $5,000 going in. Well, look at that. You can potentially improve your situation by 1 year by having a little bit of rental income. So if you can house hack while living there, that is an ideal situation, because then you also get to write off some of the expenses of living there. Okay, so that I would say, if you can house hack, definitely do it. The lower the interest rate, the better. Now, in today's market, if it's your primary residence, you may be able to get an interest rate of 12% just for the year. And by doing that, you definitely increase improve the amount of years you need to be able to make it worthwhile to transition from a negative IRR to a positive IRR. Okay. So, if you can do it, it makes sense. Now, so let's increase the 1 year to 2 years, and let's see what happens here. So this is saying that in our second year, we're still going to be paying the 90,000 in private lending, and it's only in the third year that we start getting the traditional mortgage. Okay, so by doing that, it moves out our positive IRR to the 6th year. So it actually adds on another 2 to 3 years of being in the negative return phase. So what that tells me is that every single year you add in for a private lend, you have to add on a significant number of years to be able to benefit from owning a property as your primary. Okay, now this is at a 3% interest rate and a 5% appreciation. So let's go up to 6% here, interest rate, and we still have the 5%. Okay, when you do that, you go from 6 years all the way to 9 years. Okay, that's significant because basically it means that you have to hold on to your property for like 9 to 10 years before you can recognize a positive return on that, the money that you originally invested. Okay, now the thing to keep in mind is that we're not looking at any sort of forced appreciation. Like, so if you were to add in a third unit, if you were to do something creative with it, like we're not considering any of that. And we're also not considering a refinancing here after year. So it wouldn't be year 5 that you would be refinancing because your year 3 would actually be your year 1. So you would be refinancing at 1, 2, 3, 4, 5. So at the end of year 7, right? At the end of year 7 is when you would be refinancing and taking advantage of this $50,000 in appreciation every single year. So potentially, so what does that give me when I sum that up? So about $300,000 in just passive 5% appreciation growth every single year. So that's what that means. So when you, at the end of year 7, if you go to refinance this, your property now is worth $1.3 million. Okay, which is fantastic. Okay, so now let's run this situation where this is your investment property. So it's not a primary, it's an investment property that you're going to buy and you're going to have a significant ROI in it. Okay. So right now with a $5,000 NOI, I'm at a 0.5% cap rate, which is like unheard of. Okay. So let's increase this to 75. Where's my 7? Okay, 75,000. So I just want to see, so a cap rate of 7.5. Okay, so that sort of makes a little bit more sense. So assuming I find a property, I'm buying it for $1 million. Okay. And then you're like, Hung, where are you going to buy a property for $1 million? Okay. There's tons of properties in Canada for $1 million. Okay. With multi-units in them. So, okay. The closing is going to be 5% still. Renovations are 5. So our down payment is still 25,000. So 250,000. Okay. That hasn't changed. So our loan is 7,500 still. So let's assume that we're going to buy this investment property and we need a private lender to come in for 2 years at 12%, okay? Because we're going to need 2 years to do renovations and stabilize, increase market rents, and then get new tenants in, and it's going to take us 2 years to do that, okay? That is not ideal, okay? Because 2 years is a little bit long to stabilize, but let's just assume that we need the 2 years. Okay, so then our monthly mortgage amount is 7,500. Mortgage payments per year is 90,000 still. Okay, so our NOI, now we're just assuming this NOI, so you do have to, for your opportunities, you actually do want to put like the right NOI in there. Okay, so 75,000. Now I'm going to assume that my NOI increases. So this is once it's stabilized, okay? So I'm going to assume a 2% increase year over year. Okay, so I'm going to copy this over, okay? Just to see what the numbers look like. Okay, so I'm going to go all the way up to 10 years here. And so what's happening is I'm still going to get the mortgage at 6%. And it's a 25-year amortization. So I'm not running the scenario with the CMHC MLI program or anything like that for now, okay? So we're going to run it at 25 and let's just see what the numbers look like. So it's a 2-year private lend, okay? So that's why over here, you'll see the debt servicing is at 90K a year, and then we go down to 57,000 because it's in the 3rd year that we're going to refinance this with a traditional bank here. Okay, so my cash flow for the first year is going to be a negative 15. Okay, so that's my NOI less my debt servicing. So I'm going to have my cash flow here negative. My second year is also going to be negative because the debt servicing is so high. But check this out. In my third year, so when I refinance this and get out of the private lend to the 6% traditional, I am now cash flowing at 20,000 for the year. Okay, that's pretty good. Okay, so now let's see the mortgage pay down. There's no mortgage pay down when you're in the first 2 years of the private lend. But now my second, but when I go into the traditional mortgage, I now get a mortgage pay down of 15,000, 16,000, and so on every single year. Okay, so now I didn't talk about this earlier, so let me show you guys how this mortgage pay down calculation works. Okay, basically I'm saying so. Okay, I have no idea how to make this number bigger here so that you could see it. But basically, it's a formula in Excel. I'm just saying, hey, you know what? If it's using a traditional mortgage, then do this calculation. Okay, and the calculation is an Excel calculation, which is just calculating the cumulative principal for that for that year period. So I'm going from month whatever, so 25, so month 25 to month 36. Okay, and that's going to give me my principal, my cumulative principal payment, which is 15,000. And it's just basically doing that calculation for me so that I don't need to do it. Okay, and then I'm adding a 5% appreciation here. So this appreciation number, a lot of people they include it in their calculations, but they don't understand the significance of it. And this is what, so when I acquire my properties, I want to focus on places, one that has cash flow, but also has appreciation. Okay. So this three cells here, the cash flow, mortgage pay down, and appreciation, that is my camping philosophy, right? I want cash flow, I want appreciation, and I want mortgage pay down. Okay. That is my whole camping strategy. If I don't have appreciation, then the return is going to be significantly less. Okay, so I'm going to show that point right now. Okay, so if I take out the appreciation, okay, so if I just leave the 5% appreciation there, let's just say by my fifth year, you can see my IRR is 16.7% per year. That's a pretty good return. Okay. So if I go 0% across the board for my appreciation, look at that. My appreciation has gone down in my fifth year, down to 5%. Okay, that's massive. So basically from like a 15% appreciation to 5% appreciation, that's significant. The reason why appreciation is so important is because it's compounding on itself every single year. Okay, and your purchase price is the starting point. Okay, so if I'm increasing this even by 1%, well, not 100. Let me go back here. So I'm going to go 1%. Okay, that's $10,000 a year of me having not to do anything. Okay, so this whole thing about the appreciation is significant. A lot of people don't care about appreciation and they're like, hey, appreciation is gravy. If I get it, great. Yes, that's all true, but you want to target places that have appreciation because of this reason. Okay, so let's just say it's 5%. Okay, and like in Toronto and Vancouver, where appreciation has been like 8+%, look at that. That's $80,000. That's somebody's 9 to 5 income. Okay, like that's significant. Okay, so let's just say our purchase price here is 2 million. Okay, and so now I'm going to leave the NOI as 95,000. Okay, so now my cap rate is at 3.8%. Okay, so this is the scenario that we see in Vancouver, which totally sucks because the cap rate's so low. Okay, but the cap rate at like 3.8% is an indication of the risk level. Okay, and it's like there's a bunch of other indications. So even though I say it sucks, it's actually a good thing too. Okay, so like you have to weigh that for yourself. Okay, so okay, so the NOI is 75,000. So now let's just see what this does for appreciation. Okay, look at this, $160,000 in appreciation from 1 year without doing anything. Okay, so now I'm going to add another 8% here. Okay, so now look at this. In the next year, where I get an 8% appreciation, it goes from 160,000 to 172,000. Okay, that's an increase of 12% from doing absolutely nothing. Okay, so appreciation is a significant thing here. So now the interesting thing to see here is that my cash flow is still negative. Okay, that's because when you increase the purchase price to 2 million, even if you go to a traditional mortgage, your mortgage payment now is significantly more because your NOI hasn't changed, right? So you're still making that income of 75,000, but your purchase price now was 2 million. So you need a bigger mortgage amount. So your cash flow now is minus $37,000. Okay. So now this is actually still an okay scenario to be in because look at this. You're in negative cash flow all the way through, okay, which is not a good situation to be in. But here's the thing though, you are still making a positive IRR by the 5th year. Okay, now the IRR is not that great here. Oh, let me put this up to 8% here. Okay, so by the 5th year in, you're making about 8.1%. Okay, that's return per year on this $2 million investment that's negative cash flowing. Okay, so if you're in a situation where you need cash flow, okay, then you don't want to be in this situation because you're negative cash flowing all the time. But if you don't need the cash flow and you want to have tax deductible expenses, okay, then this may be an okay situation for you because here's the thing. Your appreciation here, this gain of 173,000 for the year. Okay, 108. Oh, this went down. Okay, this appreciation amount, when you go to the bank and refinance in 5 years, so this is going to be refinancing at the end of year 7. Okay, you're going to have a total of $720,000 in passive appreciation that you can go to the bank and refinance and pull out potentially completely tax-free. Okay, so I'm just going to say that again, that you need to go talk to an accountant on this one, okay? Because this strategy is not right for everybody, okay? Because one, you have to consider that you're going to be in a negative cash flowing situation on this building for 7 years, okay, at around, $30,000 to $105,000 a year, potentially depending on the year that you're in. Okay, but then you're going to be able to pull out $700,000 potentially when you go to refinance. Now, if you can increase the NOI, so let's just say by the 3rd year in, okay, you're able to significantly increase the rental income. Okay, and so now we're going to go up here and we're going to increase this to 10%. Okay, so even if you are able to increase the NOI significantly every single year, like by 10% or something, and then, you're stabilizing it and you're only increasing it by 2, you're still in a negative cash flowing situation here. Okay, that's a big deal. Okay, but it's not as bad, okay, because it, like, by the time your 8th year rolls in, you're only negative cash flowing 12,000. So that's about $1,000 a month, okay? But you're recognizing $100,000 in passive appreciation. So you sort of need to weigh that and be like, okay, is it worthwhile for me to be in a negative cash flowing situation while I get this appreciation? Or what else can I do to increase my NOI so that I'm not in negative cash flowing position. Okay, so if you have any questions on this, or if you've got a different viewpoint, please let me know, okay? I am still learning and analyzing and figuring out what's right for me as well. So please do not hesitate to tell me I'm wrong, okay? All right, so hopefully that answers the questions for those of you who are debating about buying a place and being like, I can't pay 12% or 15% on my primary residence for a year or two. I can't buy an investment property and pay private lending money at 12 or 15% for 1 or 2 years. Okay, hopefully this sheds some light as to what the numbers will look like. Yeah, so there we go. All right, so let me go into the question here that I have. Okay, so this came through, and this is a really sucky situation to be in. But now I know a lot of people have actually been in this situation, because this is not the first time I've come across this scenario. Okay, so it says, hi, Hong, I've racked up credit card debt over the last year because I couldn't work. Okay, so for whatever reason, this individual, got sick, got injured, couldn't work, had some family issues, couldn't work. Okay, so they need to renovate their basement unit to potentially get some rental income. Okay, so that's a great idea. If you can renovate your basement and convert it to an in-law suite, if you can house hack in any way, even if it's a room, even if it's your garage, do it. It's definitely worth it. But you need to run the analysis to say, okay, well, if I spend 20,000 and it takes me 5 years to get that, does that make sense? Okay, if I put in, let's say, 2,000 bucks and I can get that money back in a year, okay, that's a different scenario. Like, absolutely. If it's only going to be, a couple of thousand and you can start renting it out quickly and make that money back, the sooner that you can make back your money, the better. Okay. So in this scenario, they've been in their current mortgage for 2 years. Okay. So that tells me that, okay, if you go to refinance, well, one, if you haven't been working for a year, it's probably going to be very hard for you to refinance, because your income is not going to show a good income, okay? Unless you've got some other passive income, or if you've got unless you have a lot of savings, or if your net worth is really high. But usually if you haven't worked for a year, your income probably won't support qualifying for a newer mortgage now, because of the stress test, the higher interest rates, and so forth. And also you may need to you may be charged a penalty from your bank for breaking your mortgage that you're in for 2 years. Okay, so you definitely do want to call them and just ask, if you're thinking about this, ask them what the penalty is to break the mortgage. Okay, so here's my suggestion is, one, like, if you need to, tap into your HELOC and use your HELOC money to do the renovations, if it makes sense to do the renovations so that you can rent out the basement. Now, if you don't have a HELOC, okay, well, that sucks, okay, because that HELOC money would be really amazing to have. Okay, so if you don't have the HELOC money, borrow the money if you can from family or friends. Maybe do like a second private lend if you're able to do that. Okay, and I do know a few private lenders who will do renovation money. Okay, so reach out to me on the QR code if you need to for that. You can use your credit card. The credit card route may be a little bit easier, because you don't have to apply for your credit card, because I'm assuming you already have a credit card here. The credit card interest rate is significantly higher, okay, like 20, 25%, depending on what type of card you have. But you're not dealing with a private lender. You're not putting a second mortgage on your house. Okay, so connect with me and I'll explain the pros and cons about doing that. Okay, the 20 to 25% interest rate is a killer, but as long as you are very good at making sure you pay down your balance on your credit card, this should be okay. Not your minimum balance, okay? It is not enough to just pay off your minimum balance, okay? Okay, now I'm hesitant on giving that advice about using your credit card because if you haven't worked in a year and you've racked up your credit card debt significantly, you probably don't have good money management or discipline to pay off the balance on your credit card. Okay. No offense, please. Okay. I'm coming from a place of love when I tell you this. Okay. But probably using your credit card is not going to be the best route because then you're not going to be able to pay off that 25% interest rate that they charge you. Okay, now the other thing that you can look at is credit cards that may allow you to transfer the balance for 3 to 6 months to a year and maybe charge you like a 2 or 3% processing fee. You could do this potentially. Okay, there's some investors that I know that move money from Peter to pay Paul, and then Paul to pay Sue, and then Sue to pay Mary. Okay, and it just keeps going in a circle for years and years and years. If you can do that, that's great. Okay, but keep in mind that that money needs to be paid back at some point. Like, it is not free money. Okay, but it does allow you to transfer the money at 2 or 3%. Okay, without a balance payment. Okay. The other thing that I would suggest is that you call your lender and have a conversation with them to say, hey, I want to, do a basement reno. I need $20,000. Can the mortgage, get a second mortgage? Can I add to it? Can I do a blend and extend? Can I get a HELOC? Or ask them to defer your current payments. Okay, now I'm not suggesting that you do a deferment, okay? Because what happens is they actually take that principal amount and they tack it on and charge you interest. So it's not like, hey, I'm just going to miss this one payment of, like if your monthly payment is 2,000, it's not just I'm going to pay this 2,000 at the end of my term. No, 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 no. It's 2,000 plus interest that has been accumulating for the rest of your term. Okay. So that 2,000 now is, like the way the math works is that you basically pay for your house. You're actually paying 1.5 houses. So if your house is worth 500,000, you're paying the 500,000 plus another 250. So that 2,000, you're actually going to be paying like $3,000 for that by the time it's all said and done. Okay. So you want to be cognizant that deferment, okay, is not like just deferring that principal or deferring that amount. It's deferring the amount plus interest for a very long time. Okay, so okay, that is a sucky situation to be in, especially, if you are a hardworking individual and you want to be able to, have a safe place for your family to live and build generational wealth. This is a sucky situation to be in, but keep in mind that you can definitely get out of it. It's a temporary situation to be in, maybe for another year or two. Okay, but it's definitely something that you could work through. So good luck with that. Okay, if you need any additional suggestions or advice on this, please reach out to me. Happy to have that conversation. Okay, I am done talking for today. Please, if you have any questions, please email me and I will be happy to answer it in the question and answer portion. If you have not subscribed to the YouTube channel, please do so, okay? It will encourage me to continue with these Monday broadcasts so that my brain is being shared with everybody out there. So please subscribe if you have not, and please share the channel. Okay, thanks everyone.